Something strange is happening in the British housing market right now. For months, we've heard the same story. Not enough homes, desperate buyers, bidding wars pushing prices through the roof. But the latest data reveals a completely different picture, one that nobody saw coming. Properties are flooding the market at levels we haven't witnessed in years, yet buyers have simply vanished. The question everyone's asking is why, and the answer might reveal something deeply unsettling about where the UK economy is really headed. If you want to stay ahead of the curve and understand what's really happening in the property market before it impacts your finances, hit that like button and subscribe to Property Reporter. We're bringing you the unfiltered truth about the UK housing scene, the economy, and the forces shaping your financial future. The numbers coming through are genuinely jaw-dropping. Estate agents across England and Wales are reporting inventory levels that have jumped by over 30% compared to this time last year. Properties that would have been snapped up within days are now sitting on the market for weeks, sometimes months. In some regions, the increase is even more dramatic. Manchester has seen available homes surge by 42%. Birmingham's market has swelled by 38%. Even in London, where supply has been chronically tight for decades, listings are up 27% year on year. This isn't a small shift or a statistical anomaly. This represents a fundamental change in market dynamics that's catching analysts completely off guard. The immediate reaction from many observers has been relief. Finally, they say, the supply crisis is easing. More homes means more choice for buyers, potentially more stable prices, maybe even a correction that brings property ownership back within reach for ordinary families. But here's where things get interesting. Despite this flood of available properties, transactions have collapsed. Mortgage approvals are down significantly from their peak. Viewings are being cancelled at unprecedented rates. Offers are being withdrawn before completion. The buyers who are supposedly desperate to get onto the property ladder have disappeared, and sellers are starting to panic. What's driving this sudden surge in supply is equally revealing. A significant portion comes from landlords exiting the market entirely. The combination of tax changes, stricter regulations, rising mortgage costs, and the threat of further government intervention has made buy to let far less attractive than it was 5 years ago. Many landlords who bought properties as pension investments are now cutting their losses and selling up. These aren't just small-time operators with 1 or 2 flats. Even large-scale portfolio holders are reducing their exposure to residential property, worried about future returns and regulatory risk. This represents a massive shift in the rental sector that will have consequences nobody's fully thought through yet. But landlords aren't the only ones flooding the market. Homeowners who've been sitting on properties for years, waiting for the perfect moment to sell, have decided that moment is now. They've watched prices climb steadily, and they're worried that the current environment, with inflation still elevated, interest rates high, and economic uncertainty everywhere, might be the last chance to cash out at peak values. There's a sense that the window is closing, that if they don't sell now, they might be stuck holding assets that decline in value for years to come. This psychology is contagious. The more people list their homes, the more others panic and follow suit, creating a self-reinforcing cycle that's pushing supply higher and higher. Then there's the new build sector, which is contributing thousands of additional units to the market. Developers who started projects 2 or 3 years ago, when demand was strong and financing was cheap, are now completing those schemes and discovering that the market has fundamentally changed beneath them. Show homes sit empty. Marketing suites report dismal foot traffic. Incentives that used to work, cashback offers, stamp duty contributions, furniture packages, aren't moving the needle anymore. Some developers are stuck, unable to secure financing for their next projects until they shift existing inventory, yet unable to shift that inventory without slashing prices to levels that would wipe out their margins entirely. The disconnect between supply and demand reveals something crucial about buyer sentiment right now. It's not that people don't want homes. It's that they can't afford them at current prices with current mortgage rates, or they're too frightened about the economic outlook to commit to the biggest financial decision of their lives. Mortgage rates, despite recent small declines, remain more than double what they were just 2 years ago. A family that could comfortably afford a £400,000 home in 2021 is now looking at properties in the £300,000 range, or they're not looking at all. The math simply doesn't work anymore for a huge segment of would-be buyers. Employment concerns are weighing heavily on people's minds too. Unemployment is ticking upward. Redundancies are increasing across multiple sectors, particularly in technology, finance, and retail. Even people who feel secure in their current jobs are watching colleagues get laid off and thinking twice about taking on enormous debt. There's a widespread sense that the economy is fragile, that things could get worse before they get better, and that now is precisely the wrong time to stretch financially. This caution is entirely rational given the circumstances, but it's creating a doom loop in the housing market where falling demand justifies more caution, which further reduces demand. First-time buyers, who are supposed to be the lifeblood of any healthy property market, are finding the barriers to entry higher than ever. Yes, there are more properties available, but that doesn't help if you can't scrape together the deposit or qualify for a mortgage. Lenders have tightened their criteria significantly. Income multiples have been reduced. Stress testing has become more rigorous. The days of getting approved with a 10% deposit and a decent credit score are largely over. Now you need 15 or 20% down, immaculate credit history, and proof of income that satisfies increasingly nervous underwriters. For young people already struggling with student debt, high rents, and a cost of living crisis, these requirements might as well be a brick wall. The regional variations in this story are absolutely fascinating. While the overall trend is toward higher supply and lower demand, some areas are experiencing this shift far more dramatically than others. Cities that saw huge price increases during the pandemic, places where remote workers flocked, seeking more space and greenery, are now seeing the sharpest reversals. Properties in Cornwall, Devon, and parts of Wales that were selling for 50% above asking price in 2021 are now getting offers 20% below asking. Sellers in these areas are shell-shocked, unable to accept that the boom has not just ended, but completely reversed. Many are refusing to drop their prices, convinced that demand will return, creating a standoff where properties sit unsold for months while the market deteriorates around them. London presents a different puzzle entirely. The capital has always operated on its own logic, driven by international buyers, financial sector bonuses, and a fundamental shortage of land. Yet even here, cracks are appearing. Prime central London, the ultra-luxury segment that weathered every previous downturn, is seeing inventory build up. Penthouses in Mayfair and Knightsbridge that would have attracted multiple offers from overseas buyers are now sitting empty. Part of this is down to geopolitical factors, sanctions on Russian oligarchs, uncertainty about Chinese investment, Brexit complications for European buyers. But there's also a sense that even the global ultra-wealthy are becoming more cautious, less willing to park huge sums in UK property when returns are uncertain and other asset classes look more attractive. The implications for house prices are obvious, but also deeply controversial. Most analysts are predicting modest declines, somewhere between 5 and 10% nationally over the next 12 to 18 months. But these forecasts assume that supply and demand find a new equilibrium relatively quickly, that mortgage rates stabilise or decline, that the broader economy avoids recession. If any of those assumptions prove wrong, the downside could be significantly worse. Some more pessimistic voices are warning of 20 or even 30% corrections in certain markets, particularly those that saw the most extreme pandemic-era inflation. Such drops would push many recent buyers into negative equity, trap people in homes they can no longer afford, and potentially trigger a wave of forced sales that would accelerate the decline. The political dimension of this crisis cannot be ignored. The government finds itself in an impossible position. On one hand, falling house prices would be politically toxic, threatening the wealth of millions of homeowners who vote reliably and view their property as their primary asset. On the other hand, rising prices have made home ownership impossible for an entire generation, creating fury among younger voters who feel locked out of the system entirely. Any intervention to support prices will be seen as protecting wealthy asset owners at the expense of first-time buyers. Any policy to increase affordability will terrify existing homeowners who fear losing equity. There's no middle ground that satisfies both groups, which means whatever the government does will alienate millions of people. What makes this moment particularly dangerous is the debt levels involved. British households are carrying record amounts of mortgage debt, much of it taken out at ultra-low interest rates that are now resetting at much higher levels. Thousands of homeowners are facing payment shocks as their fixed-rate deals expire, and they're forced to remortgage at rates 2 or 3 times higher than they were paying. For some, this means cutting back on discrete, ordinary spending, holidays, restaurants, entertainment. For others, it means genuine financial distress, the possibility of default, repossession, bankruptcy. The ripple effects of this mortgage time bomb will hit the broader economy hard over the next 2 years, reducing consumer spending and potentially tipping the country into recession. The rental market is being transformed as well, though not in the way many predicted. The exodus of landlords was supposed to reduce rental supply and push rents even higher, creating a crisis for tenants. That's happening in some areas, but in others, particularly where landlords are concentrated, the opposite is occurring. Properties being sold are often being bought by owner-occupiers, removing them from the rental pool entirely. This is reducing rental supply, yes, but it's also reducing demand because those buyers are leaving the rental market. Meanwhile, new purpose-built rental developments are completing and adding high-quality supply in city centres. The net result is a rental market that's bifurcating, with nice properties in good areas becoming more affordable, while poor quality stock in undesirable locations sits empty or commands very low rents. International comparisons make the UK situation look even more precarious. Other countries that experienced similar pandemic-era housing booms are already seeing sharp corrections. Canada's housing market has dropped nearly 20% from its peak. New Zealand is down over 25%. Australia is wobbling. Sweden has seen significant declines. These markets tend to lead the UK by 6 to 12 months, which suggests that the worst may still be ahead for British property owners. The idea that UK housing is somehow immune to gravity, that prices only ever go up, is being tested in real time, and the results may shatter decades of assumptions. For buyers still in the market, the strategy has shifted entirely. 12 months ago, it was about speed, making offers over asking, waiving surveys, doing whatever it took to secure a property before someone else did. Now it's about patience and negotiation. Properties are sitting longer, which means buyers have leverage. Sellers are more willing to negotiate, to accept offers below asking, to include extras in the deal. Smart buyers are taking their time, doing thorough inspections, and making low offers, knowing that desperate sellers may accept just to get the deal done. This shift in power from sellers to buyers represents one of the most dramatic reversals in market psychology in recent memory. Mortgage brokers are reporting strange conversations with clients. People who've been pre-approved and found properties they like are pulling out at the last minute, spooked by news headlines or cold feet about the economic outlook. Others are asking whether they should wait 6 months to see if prices fall further, gambling that the savings from buying lower will outweigh the cost of renting in the meantime. There are no easy answers to these questions. Timing the market is notoriously difficult, and those who wait for the perfect moment often miss opportunities entirely. But the fear and uncertainty in the air is palpable, and it's changing behaviour in ways that feed back into the market and accelerate the trends everyone's worried about. Estate agents, who were making enormous commissions during the boom years, are now facing a severe income crunch. Fewer transactions mean fewer fees, and many. Agents who expanded their operations during the good times are now laying off staff or closing branches entirely. The industry is consolidating, with online operators and discount brokers gaining market share at the expense of traditional high street agents. This shift was happening anyway, but the current market downturn is accelerating it dramatically. Within a few years, the estate agency landscape could look completely different, dominated by a handful of large players and digital platforms rather than the local independent agents that have been a fixture of British high streets for generations. The broader economic implications are staggering. The housing market touches almost every aspect of the British economy. When people buy homes, they also buy furniture, appliances, renovation services, gardening equipment. They hire plumbers, electricians, decorators. A booming housing market generates enormous economic activity in related sectors. The reverse is also true. A stalling market means all those related industries suffer. Retailers like IKEA and B&Q are already reporting weaker sales. Tradespeople are finding work harder to come by. Mortgage brokers, surveyors, solicitors who specialise in conveyancing, all are seeing their businesses contract. The multiplier effects of a housing downturn ripple through the economy in ways that official statistics often underestimate. Financial markets are watching all this with growing alarm. Banks and building societies have enormous exposure to residential mortgages, and any significant increase in defaults could threaten their balance sheets. So far, arrears remain low by historical standards, but they're rising, and the trend is concerning. Lenders are setting aside larger provisions for potential bad loans, which reduces their profitability and their ability to lend. This creates another feedback loop where tighter lending standards reduce demand, which weakens prices, which increases the risk of negative equity and default, which forces lenders to be even more cautious. Breaking this cycle requires either a significant improvement in economic conditions or bold policy intervention, neither of which appears likely in the near term. The psychological shift happening right now cannot be overstated. For 20 years, buying property was seen as a one-way bet, a guaranteed path to wealth accumulation. Parents advised their children to get on the ladder as soon as possible, no matter the cost, because prices would always go up. That certainty is evaporating. Young people are questioning whether home ownership is worth the sacrifice when prices might fall, when they might be stuck in negative equity, when renting offers flexibility that owning doesn't. This generational shift in attitudes toward property could have profound long-term consequences for the market, reducing demand structurally, even if affordability improves. If owning a home stops being an automatic life goal for millions of people, the entire basis of UK housing economics changes. The government's response so far has been tentative and inadequate. There's been talk of helping first-time buyers, maybe bringing back Help to Buy schemes or offering new tax incentives. But these measures, even if implemented, are band-aids on a much deeper problem. The fundamental issue is that property in the UK is too expensive relative to incomes, and has been for years. Any policy that tries to maintain current price levels by making it easier or people to borrow more simply perpetuates the problem and potentially inflates the bubble further. What's really needed is a sustained period of prices staying flat or declining while incomes rise, allowing affordability to improve naturally. But that would take years, possibly a decade, and require political courage that no government has shown any willingness to muster. Developers are facing existential questions about their business models. If the market for new homes has fundamentally weakened, does it make sense to keep building at current rates? Many are scaling back their pipelines, postponing or cancelling projects that haven't started construction yet. This will reduce housing supply in the medium term, potentially creating another crunch down the line. But from the developer's perspective, building homes nobody wants to buy at prices that don't cover costs is a recipe for bankruptcy. The industry is caught between government pressure to build more houses and market reality that says demand isn't there at current price points. Resolving this tension will require either significant price reductions, which wipe out developer margins, or sustained economic improvement that brings buyers back to the market. One factor that hasn't received enough attention is the climate angle. Properties that are energy inefficient are becoming harder to sell as buyers become more conscious of running costs and future regulatory requirements. Homes with poor EPC ratings, especially those below a C rating, are sitting on the market longer and selling for less. This is creating a two-tier market where modern, efficient properties hold their value, while older, less efficient homes are effectively discounted. The government's push toward net zero means this gap will only widen over time as minimum energy standards rise and properties that don't meet them become unlettable or unsellable. For owners of older housing stock, the cost of upgrades could be enormous, potentially tens of thousands of pounds per property, yet failing to invest means their assets lose value anyway. The situation in Scotland and Northern Ireland adds yet more complexity to this picture. Scotland's housing market has traditionally lagged England's, and that pattern is holding true now. Price growth has been weaker, supply is less constrained in many areas, and the impact of rising interest rates is being felt less severely. Northern Ireland's market is small and quirky, influenced by its own economic and political dynamics. But both nations are watching what happens in England closely, knowing that major disruptions there eventually ripple outward. If English property prices fall sharply, Scottish and Northern Irish markets will likely follow, though perhaps with a lag and to a lesser degree. Investors who treat property as an asset class rather than a place to live are reassessing their positions entirely. Funds that own residential portfolios are marking down the value of their holdings, recognizing that market conditions have deteriorated. Some are looking to exit entirely, selling blocks of properties to other institutional investors at discounts. This creates opportunities for well-capitalized buyers who can afford to take a long-term view, but it also signals how seriously professional investors are taking the current downturn. When the smart money starts heading for the exits, it's usually a sign that worse is yet to come. The cultural mythology around British prop RTI is being challenged like never before. The idea that owning your home is the ultimate achievement, the foundation of financial security, has been drilled into the national psyche for generations. But that narrative is cracking under the weight of economic reality. People are starting to ask uncomfortable questions. Why do we treat housing as an investment rather than a basic need? Why have we allowed prices to become so disconnected from wages? Why is so much national wealth tied up in unproductive assets that just sit there rather than generating economic growth? These are questions that politicians have avoided for decades, but they're becoming impossible to ignore as the housing market convulses and millions of people find themselves either trapped in overpriced properties or locked out of ownership entirely. What happens next depends on factors that are genuinely uncertain. If the Bank of England cuts interest rates significantly over the next year, mortgage costs will come down and buyer affordability will improve, potentially stabilising prices. If inflation remains stubborn and rates stay high, the market could deteriorate further. If the economy tips into recession, job losses and financial stress will force more sales and depress demand even more. If wages somehow start growing faster than prices, affordability will gradually improve without prices having to crash. Each of these scenarios is plausible, and which one materializes will determine whether we're looking at a minor correction or a full-blown crisis. The one certainty is that the housing market of the next 5 years will look nothing like the last 5. The era of easy money, ultra-low interest rates, and ever-rising prices is over, probably for good. What replaces it is still taking shape, but it will require everyone involved, buyers, sellers, lenders, policymakers, to adjust their expectations and behaviours dramatically. Those who cling to outdated assumptions will find themselves burned. Those who adapt quickly to the new reality will find opportunities that didn't exist before. The great British property machine is sputtering, and whether it's just a temporary stall or a permanent breakdown remains the biggest financial question facing the nation right now.